Hey everyone, welcome back to Corporate Decoder, the place where we unravel the hidden stories in your favorite company's financial documents. Today we're diving into an amendment to US Gold Corp's annual report, and let's just say it seems like they're trying to clean up a few things. Make sure you stick around because we're going to decode what this all means for the company. And hey, if you love getting straight answers from these dense filings, hit subscribe and join our growing community. We also have a Discord server where you can connect with other finance enthusiasts, all linked in the description below. Alright, so what we have here is an amendment to us Gold Corp S annual report, a Form 10 KTI. Think of it like a company filing its yearly report, then realizing they missed a few things or made a mistake, so they file an amendment to correct it. It's for the fiscal year that ended back on the 30th of April, 2025. The main reason for this amendment is to fix some issues with their past filings, specifically around disclosing important information on the cover page and in Part 3, which covers things like directors and executive compensation. They also had to add some new risks related to how they manage their disclosures and some recent sales of their stock. The company is being pretty upfront about why they're filing this amendment. They state they're amending the original report to correct how they disclosed information, add new risk factors, and update their management's evaluation of their disclosure controls. Essentially, they're admitting their internal systems for making sure all necessary information is disclosed properly weren't working perfectly. They are also filing new exhibits which are like supporting documents. The good news, they say, is that these changes do not affect their financial statements, so those remain the same. Now, this is where things get interesting. One of the main risks they're highlighting is that their management concluded their disclosure controls and procedures were not effective as of the 30th of April 2025. Basically, they admit they did not have strong enough systems in place to ensure all required information was reported on time. This is a big deal because proper disclosure is crucial for investor trust. If a company can't accurately and timely report its financial results, it can lead to a drop in stock price, potential delisting from the stock exchange, and damage to its reputation. They're also saying there is substantial doubt about whether they can continue as a going concern. This means they don't have enough money to operate for the next year without getting more funding. They've had no revenue so far and significant accumulated losses, with only about $8.2 million in cash. The company is in the exploration stage, meaning they are looking for valuable minerals like gold, but they haven't actually produced any yet. They've spent money on exploring their properties, but there is no guarantee they will ever find enough valuable minerals to make mining profitable. This process requires a lot of capital, and they might not be successful in securing the necessary financing. All this uncertainty means they are taking on significant risks. This is a recurring theme. They need a lot more money to keep exploring and developing their projects. Their ability to get this funding depends on the economy and the price of gold. If they can't get the money they need, they might have to delay or even stop their exploration activities. This could lead to a loss of their potential interest in their properties. Let's talk about the core business risks for a mining exploration company. First off, they don't actually know if their properties contain any gold or other minerals that can be mined at a profit. Even if they find something, the market price of gold is super volatile. Plus, most of their projects are still in the early exploration phase, meaning they haven't proven if there are even enough valuable minerals to justify mining. This is another critical point. They have zero history of actually producing metals from the properties they're exploring. All the risks of starting a new mining operation are present, including the high costs and lengthy timelines for construction, the need for skilled labor and equipment, getting permits, and facing potential opposition from environmental groups or local communities. There's no guarantee they will ever be able to mine profitably. Getting the necessary government permits and licenses is another hurdle. Mining and exploration are heavily regulated, and these processes can be expensive and time-consuming. Delays or denials of permits could significantly impact their plans and increase costs. Now, let's shift gears to what this might mean for investors. Theresa mentioned of certain shares sold under a controlled equity offering sales agreement. It turns out because they failed to timely file part of their original report, some of those sales might have been made improperly. This could mean that the buyers of those shares might have certain rights or could seek damages. The company could also face penalties from regulators. This is on top of the fact that their stock price is likely to be quite volatile. The stock price can swing wildly due to a lot of factors, including their exploration results, the price of gold, their ability to get funding, and even just the general investor sentiment towards their industry. This volatility means you might not be able to sell your shares at a price you want. They also warn that this volatility could lead to securities litigation, which can be very costly and distract management. Even though their stock is on Nasdaq, the trading activity is limited. This means it might be hard to buy or sell shares when you want to, and the price could be easily influenced. They also mentioned that many brokers might not want to deal with their stock because of its low price, which can make it even harder to trade. And importantly, they don't plan to pay any dividends in the foreseeable future, meaning any return on investment would come solely from the stock price going up. Getting back to those disclosure control issues, the company S Management has restated their evaluation. They initially thought their controls were working, but after realizing they had to file this amendment late, they concluded that their disclosure controls and procedures were not effective as of the 30th of April 2025. They plan to fix this by formalizing their processes for tracking filing deadlines and expanding training for staff. Interestingly, while their disclosure controls weren't T-effective, management concluded that their internal controls over financial reporting were still effective as of the 30th of April 2025. This means they believe their systems for ensuring the accuracy of their financial statements themselves are sound, even if their systems for disclosing information to the public had some hiccups. Let's look at who's running the show. As of the 30th of September 2025, there are 5 directors. Luke Norman is the chairman, and George B. is the president CEO, and a director, Robert W. Schaefer, Michael Waldkirch, and Johanna Fipke round out the board. The biographies highlight extensive experience in mining, finance, and law, which is good for guiding a company in this industry. The executive officers are George B. as president and CEO, Eric Alexander as chief financial officer, and Kevin Francis as vice president of exploration and technical services. Their backgrounds also suggest strong experience relevant to the mining and finance sectors. Now, for the executive compensation for the fiscal year 2025, George B., the CEO, earned a total of over $1 million, including salary, bonus, and stock awards. Eric Alexander, the CFO, earned over $781,000, and Kevin Francis, the VP of Exploration, earned over $588,000. These numbers include base salaries, bonuses, and the grant date fair value of stock awards and options. It's important to note these figures reflect the value of awards on the grant date, not necessarily the actual amount realized by the executives. Looking at outstanding equity awards as of the 30th of April 2025, the named executive officers held a number of unvested stock options and restricted stock units. For example, George B. had stock options and ARIS representing a significant potential future value, depending on the company S stock performance. These awards usually vest over time and are meant to incentivize long-term performance. For the non-employee directors, they receive quarterly cash retainers with extra for committee chairs and an annual stock retainer in the form of restricted stock units, deferred stock units, or stock options. For fiscal year 2025, Luke Norman's total compensation as a director, including cash retainers and consulting fees, was over $500,000. Other non-employee directors received compensation in the range of $133,000 to $213,000 for their services, primarily in stock awards and options. Under their equity compensation plans approved by security holders, there are over 1 million securities that can be issued upon exercise of outstanding options, warrants, and rights. There are also over 1.3 million securities available for future issuance. This shows the company has a mechanism for granting equity to employees and management. As of the 26th of September 2025, certain individuals and groups beneficially owned a significant portion of the company's stock. George B. owned over 522,000 shares, representing about 3.55%. The group of current directors and executive officers collectively owned over 1.5 million shares, totaling about 10.06%. Two major holders, Phoenix Gold Fund Ltd and Thomas B. Akin and Karen Hoxter, own over 5.4% and over 12.1% respectively. This section details related party transactions. Specifically, Mr. Norman, who is a director and chairman, received over $210,000 in cash for consulting fees in fiscal year 2025. He also received grants of deferred stock units and stock options for his services. This is common practice for companies to leverage the expertise of their board members, but it is important to note these transactions. The board has determined that 3 of its 5 directors are independent, meaning they don't have significant financial or personal ties to the company that could compromise their judgment. This is important for good corporate governance. The company's independent auditor, Markham LLP, billed them over $213,000 for audit fees in fiscal year 2025, which is an increase from about $191,000 in 2024. These fees covered their annual audit and reviews of quarterly reports. There were no significant audit-related tax or other fees billed by Markham. The Audit Committee pre-approves all services provided by the auditor. This section is essentially a list of all the documents that are part of this filing, including articles of incorporation, bylaws, employment agreements, and the company's stock incentive plan. Some of these are incorporated by reference from previous filings, meaning they are too long to include again, but are considered part of this report. Crucially, this amendment adds new exhibits like certain employment and consulting agreements, and also includes the required certifications for the CEO and CFO, which we'll discuss next. Finally, we have the certifications from the Principal Executive Officer and Principal Financial and Accounting Officer. George B., the CEO, and Eric Alexander, the CFO, have certified that they have reviewed the report and that, to the best of their knowledge, it does not contain any untrue statements or omit any material facts. These certifications are a legal requirement to ensure that the company's leadership stands behind the accuracy of their filings. So, diving into US Gold Corp amended filing, it's clear they're addressing some significant disclosure and procedural issues. The fact that they've had to amend their annual report to correct past disclosures, particularly around Part 3, which details leadership and executive pay, raises some flags about their internal controls. While they claim their financial statements themselves are accurate, the admission of ineffective disclosure controls and procedures is a point of concern for transparency. Compounding this, the company acknowledges substantial doubt about its ability to continue as a going concern, with very limited cash and significant accumulated losses. They are still in the exploration phase with no operating revenue and rely heavily on raising more capital, which is a risky proposition. For investors, the stock price volatility is a major factor, coupled with the limited trading market. The fact that they are not paying dividends and are relying solely on potential stock appreciation in an environment where disclosure issues have arisen creates a challenging investment profile. The executive compensation appears substantial relative to the company's current stage and lack of revenue, though it is tied to stock awards and options which align to some extent with shareholder interests. However, the overall picture is one of a company facing significant financial and operational risks, trying to navigate its way through the early stages of exploration while grappling with internal control and disclosure challenges. The company's direction hinges entirely on its ability to secure substantial funding and eventually discover and profitably mine valuable mineral deposits, all while improving its disclosure practices. It's a high-risk, high-reward scenario, with the risks currently appearing quite pronounced. Alright, that is our deep dive into US Gold Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.